Happy Monday, everybody. Today is February 27, 2023, and this is your Monday Market Update. Let's recap last week and preview this coming week. Let's jump right in. Stocks started the holiday shortened week on Tuesday morning where it had left off and hit day 5 in a row with a downside gap open. For the first 30 days of 2023, the S&P did finish higher than it opened on 21 separate occasions. This leads to another stat on when this happens. The median return for the rest of that year is 11.3%. That means what? Absolutely nothing. Unless it does mean something, we'll see. Well, Tuesday was not to be one of those days anyway, but we'll get to that in a second. Another quick data point, the 19th of February marked 3 years since the pre-COVID high on the S&P 500. Total return for that 3-year period, 8.59% positive. Back to Tuesday. Eco data hurt the markets. Eurozone, UK, Germany, all with strong reports. Good news is still bad news, even across the pond. And then Walmart and Home Depot added to the red with disappointing earnings. 2-year Treasury auction, highest yield since summer of 2007. Markets are fighting the tape. Higher terminal rate predictions, higher dollar, higher yields. Add in geopolitics, China, China and Russia backing out of the nuclear treaty. Remember, I still think valuations are key. As the market comes down, valuations get better, not worse, unless that comes along with lower earnings. Markets closed pretty ugly to the downside. S&P and Dow both down 2%, and the NASDAQ down 2.5%. Markets opened with a whimper, not a thud on Wednesday as the selling continued, but at a much more tame pace. Hot CPI print in Germany made people rethink the fact that inflation was coming under control. That makes people think that global central banks are going to stay aggressive, as they have told us. Speaking of which, Fed head Bullard spoke before the bell, reiterated the 5.375% terminal rate, which is pretty much exactly where the market is pricing rates. New lows came in soon after the open. The Treasury yield started to drift lower, and there was some positioning that brought the buying back in. New session highs hit as the Fed minutes were released. Minutes ended up being a bit hawkish, pretty much telling us more of what we knew, nothing more earth-shattering about the few policymakers that favored a 50 basis point move versus the 25 that we got. Again, not news here, and the minutes told us what we knew. As I mentioned to you last week, this was more of a non-event. 2 most notable items. First, as I said, almost all the Fed officials agree on the 25 basis points. And second, there was virtually no mention of a pause in rate hikes. One notable comment that backs what I've been saying, quote, slowing down the pace would better allow them to assess the economy's progress. Again, as expected, no surprises. I look at this like parking a car in a small space. Do you zip right in, even with all the backup cameras and sensors, or do you inch in a little bit at a time so you can make adjustments that are necessary? That's the way I look at how the Fed's doing this. The stocks did roll over in the afternoon, set new session lows, then bounced but closed over the 4,000 mark on the S&P. Overall, markets barely budged. Dow down 0.25%, S&P down less than 0.25%, and the NASDAQ up less than 0.25%. Thursday was a new one. Stocks gapped higher on the open. South Korea ended its rate hike campaign, so the runaway, runaway hiking train can be stopped. Nvidia proved that the money can be made in chips, and they surprised the streets with their numbers. Some optimism crept back in. Markets failed to hold the gains, though. Jamie Dimon from JP Morgan was on the tape interview with CNBC. But aside from that, slow news day. Market prepping for the PCE on Friday, along with the other eco data, and the Dow was up a third of 1%, S&P up 0.5%, and the NASDAQ up 0.75%. Friday brought the next batch of eco data that the market was waiting for, PCE and consumer sentiment and inflation expectations. PCE was hot, consumer sentiment was up, bullishness was down, bearishness was up. As we know all this is usually viewed as contra indicators. Regardless, the market was not happy with these numbers. On the day, the Dow was down 1%, S&P down also 1%, and the NASDAQ down about 1.75%. The biggest weekly losses this year in 2023, the Dow was down 3% for the week, S&P down 2.7% for the week, and the NASDAQ was down 3.3% on the week. Some say this is not only a reaction to the eco data and the Fed, but maybe some of the fluff that I've been talking about is also being unwound. More on that in just a moment. Few notable facts. Vanda Research says that the retail investors have been putting $1.5 billion to work daily this year into stocks. That's a reversal from last year. Also, a reminder that according to Fundstrat and a whole bunch of other sources that I've seen, there's nearly $5 trillion on the sidelines right now. Admit this. And the idea that at 4% plus in many cases, refer to my Friday videos about cash management for information on that, but it'll take something to get that money into the game. Demographics are also at play. Millions of millennials are about to enter the midlife crisis mode, spend less, divorce less, and value experiences. How does that affect the markets? Fed expectations. A few weeks ago, the Fed funds futures were indicating that the markets expected the terminal rate was 4.75%. It has moved up to close to 5.3%, as I mentioned, and only one, not two, cuts before the end of 2023. Buzzword bingo. This is what I've been talking about with the latest and the fluff. Artificial intelligence, AI. A few months ago, it was the metaverse. Before that, it was the blockchain. And even before that, it was autonomous cars. Just note that with the bingo words I mentioned, pure play investments and how to monetize them are two things that are missing. More also missing, profits. But we'll leave it at that and see how that comes about. Debt ceiling and student loan forgiveness is on the agenda this week. Listen out for that. I've discussed the student loans on the Friday videos a lot. Keep up there. The debt ceiling raised 78 times since 1960, suspended 7 times, and a stalemate twice. This will be gaining headlines. Watch out for it. 2011, the stalemate led to a downgrade in the credit rating for the U.S. So let's do a quick rundown of what we'll watch this coming week. There's a lot coming, but I'll tell you, not so much to move markets. We wait until March 10 for the February jobs report, March 14 for the next CPI. Fed heads, Jefferson Monday, the new Chicago Fed President Goolsbee on Tuesday, Kashkari on Wednesday and Thursday, Waller on Thursday, and Logan and Bowman on Friday. We will get more earnings from retailers and some technology companies this is important. We'll get some secondary eco data, and we should hear from SCOTUS on the student loan forgiveness. Don't be surprised to hear a lot about the Oracle of Omaha today. Warren Buffett published his annual report over the weekend. This is always good reading. Okay, I threw a bunch at you this week, and it was a short week. We have a full week this week, and seems like there'll be less to report on, but don't let that fool you. There's always a lot bubbling under the surface. Stay tuned as I will keep you informed of what all of that means, in my opinion, on these Monday videos. Friday will be another video about the planning ideas, so come back for that. We may even have some info on the student loans to update you on. We'll see you soon. Have a great week.